Thanks for tuning into our next video blog in our ongoing video newsletter series. We're here today to talk about alternatives. But before we start on that, we're pointing out the plant, that it's bright, healthy and green, being watered and pruned.
It seemed to generate a lot of concern amongst everybody as our viewers, so we thought we'll make reference, it's in excellent health, thank you.
And we thank you for your concern about the plant. So alternatives. Steve, it's something that we recommend in our clients' portfolios, and we get a lot of questions about it. What are alternatives and why do we use them?
Yep. Okay, well, alternatives, is something that we use a lot more these days. It's a broad label that applies to a lot of different types of investments. Those investments aren't necessarily all the same. Anything that is an alternative to your traditional bonds, shares, cash, the types of property, the types of asset classes that we're used to hearing about and knowing about, anything that doesn't fit into those boxes and operates differently is often given the broad brush label of alternatives.
So alternatives are anything that's not shares, bonds, cash and maybe property?
Yeah, to a broad extent, absolutely. When we talk about our alternatives in our portfolio, traditionally we mean managed fund products. That's because a lot of the alternative investments that we would seek to get exposure to so that we can get that alternative performance and alternative risk to shares and bonds and cash can only be accessed through managed funds. They're often either say a hedge fund or a fund of many hedge funds where there's specific investment strategies that can be quite complicated, run by managers with quite a bit of very nuanced and specific skills, not easily replicated on the street by the rest of us mere mortals. And so we get access to those through managed funds, or they might be really big projects like infrastructure is often lumped as an alternative. It could be investing in overseas markets and currencies, and those type of things are often most easily accessed through managed funds.
You've mentioned a few things there that we get a number of questions about, but I'll start with, why do we need something that's different to shares and bonds and cash? Why do we need that?
Absolutely, and there's several purposes that alternatives serve. The first one is diversification. So we're all fairly familiar with the idea of diversification and not all your eggs in one basket, but it goes broadly for both returns and for risks, in that shares and bonds often move in pretty distinct cycles, ups and downs, hopefully overall up, but generally they do have their ups and downs in between the averages. And you try and smooth out the volatility, those ups and downs of shares using bonds and cash. Property will move similar to shares.
Especially listed property.
Especially listed property, and those type of commercial property can be quite tied to shares. But generally you're trying to mix different types of assets, different types of investments to smooth out those ups and downs. And alternatives are excellent at smoothing the ride because they're largely uncorrelated, so they don't move in relation to shares and bonds. So bonds are often considered negatively or lowly correlated with shares, so that means in a gross sense, when shares are up, bonds are down, or when bonds are up, shares are down. It's not strictly quite that easy, but it's generally, that's the concept of correlation. And alternatives have virtually no correlation to shares or bonds or property. They go out and they have their own patterns, their own cycles, and generally then by adding something that has no correlation to those traditional assets, you smooth out the overall investment portfolio even more than normal. And then at the same time, alternatives on a return point of view help reduce the help maintain the return. So we're in a low growth environment is what everybody tells us going forward. You know, shares, property, and bonds, everything is expected to have lower returns than maybe we've been used to getting in the last couple of decades, you know, for systemic reasons around the world. So alternatives aim to break out of that cycle and maintain a healthy return, despite the economics of the cycle.
So the idea of a portfolio, we're not actually looking at let's put all our eggs in one basket because shares are going to do great. We create a portfolio so that clients can, their overall situation just sort of moves along in a smooth way, hopefully upward.
Yeah, absolutely.
Okay.
So, I mean, if you're looking for just the best performance, the absolute highest return over a 10-year period, you'd probably just put all of your money into purely shares. You just wouldn't worry about any exposure to the alternatives or to bonds and cash. You just go, but that's a hell of a ride, as the GFC will show. And 99% of people, the journey matters as well as the destination. Occasionally there are some people who say, I can just stick that money in and I don't need to look at it for 10 years. And I won't look at it for 10 years because there's a difference between saying and doing. But if people can, shut their money away and forget about it for decades, then shares historically and even looking into the future are expected to be the number one long-term performance. But that said, we're often adding to our investments over time or taking money from our investments at different time. We might need income to pay for the expenses. Even something as simple as property, you need income to pay for mortgages and loans and so forth. So it's very, very rare that you'll just lock your money away and forget about it and just aim for the highest return, because that's not practical in a real world sense.
So we use alternatives to diversify the portfolio in a way that is not correlated to the other asset classes. You also used words like hedge funds. Now, hedge funds have a very bad reputation. Yeah. They have this very scary persona. What's a hedge fund, and why would we recommend something so awful in our portfolios?
Yeah, absolutely. Hedge funds have particularly in the last 10 years and through the GFC and all that type of times, that hedge funds have got a bad rap and a bad name. A hedge fund is simply a managed fund. So your old school managed funds or the managed funds that they run in the US is where a lot of these hedge funds are domiciled, but not necessarily all of them. So a hedge fund is simply a managed fund that has an investment strategy that is, they use strategy and techniques and formulas and to try and do things different other than just buying shares, buying bonds, buying an asset, holding the asset and then getting rid of it when you no longer think there's value in it.
So one of the things, through the global financial crisis, the GFC, there was obviously a lot of media comments about short sellers. Are they hedge funds?
Most hedge funds, most people who use short selling in their funds get labelled as a hedge fund. There are some more traditional share funds that will have some short sellers, people who use these financial instruments to add a bit of different characteristics to their share funds, but generally they don't get labelled as a hedge fund unless they use a lot of it.
But it's not just those.
No, well, so a hedge fund can be, there are the big scary ones where people have had a lot of, really the problem is leveraged gearing, borrowing other people's money effectively to, increase the risk, but also increase the return. And they're the ones that kind of got into trouble in the GFC. But hedge funds is like the label alternatives, captures a lot of different types of strategies and investors. So some hedge fund managers will do, or a very popular one is called momentum trading, using managed futures. These are just, I guess, fancy technical labels for people who find trends in different investment markets around the world and then try and follow the trend.
So we read in the press, the trend is your friend. Is that this is taking it to an extreme.
Yeah, and they use the science. These people are actually not traditionally investment specialists. They're actually mathematicians and PhDs and university types who look at the data and do it purely from a scientific point of view. And that particular, sometimes they call them macro strategies, but these momentum traders, it's all around the maths and the numbers, very sophisticated formulas and computer programs, and they've been doing a lot of that quite successfully for many decades now. And that's that's a fairly staple type of hedge fund these days. But then you have your more kind of what you'd consider, definitely hedge funds are commodity traders, people who trade currencies, but purely for speculative purposes, people who trade all sorts of, it might be water rights, it might be gold or options and futures over gold, it can be all sorts of stuff.
So how do I avoid, or how do I as an investor, like some of these things sound quite risky, how are you keeping my risk down?
Yeah. Well, some of them are risky and some of them are very low risk, depending on what strategies you're talking about. So the best thing is with hedge funds and alternatives is diversification. So most of the managed funds that we use in clients' portfolios are fund of funds. So that means in one fund that you invest in, there are sub-funds of anywhere from 10 to 20, even 30 other funds underneath that, going across all these different types of strategies. And that is one way of getting a piece of the benefit of those specific strategies. Some of them can be very profitable, some of them can be nice profit at extremely low risk, and by blending them together in a fund of funds, you get a bit of exposure to all of those.
So we get diversification in our portfolio with shares and bonds and cash and alternatives, but then the alternatives also have diversification. Absolutely.
So you're diversifying against the manager's skill of any one manager. You're relying on the skill of these hedge fund managers getting it right. If that manager gets it wrong, we want to be exposed to 20 or 30 to kind of dilute out those little mistakes.
The same way, if you have Australian shares, you don't have all your money in BHP. You probably have some money, or possibly have some money in BHP, but then also some money in a bank or whatever.
Yeah.
Right.
And you'll find with the hedge funds that the risk, as people think of them, about blowing up and losing all their money, is actually extremely small, probably even smaller the way they set them up these days than your traditional share fund managers. They have a lot better controls and a lot better monitoring through their systems that they have been forced to build since the GFC, that we can now track in real time the exposure that the fund managers have at the lower investment level.
So we've talked about hedge funds, we've talked about momentum traders, the trend is your friend funds. Are there any other types of alternatives that aren't kind of captured by those two things?
The biggest one, the one that we're having a bit more exposure to, is private equity, venture capital, that type of off-market investing in businesses. So similar to share market investment, but getting in at an earlier stage before they're listed on the stock market. And some of these companies can be quite big. They're not necessarily little minnows, but they just simply haven't gone to the stock market for capital before. They've used private funding. And so there's a few fund managers who are now starting to build these venture capital or private equity type investment managed funds.
Now they have some tax benefits, don't they?
The venture capital stuff can have some benefits. They will be able to get some tax breaks. It's specific to each different investment.
Right.
So we'll, if that comes up and it's relevant to clients, we'll let them know.
Right. So there's a few different alternatives now. Some people think property or infrastructure is an alternative. Do we classify it as an alternative?
We don't. That's because there is still a fairly high correlation in infrastructure to traditional property and to traditional equities. So we want that exposure, we want infrastructure, we want property exposure, we want the growth of equities and those type of things. And it does get you a little bit away from that. They're not perfectly correlated. They're quite low compared to, say, your listed property trusts. It's not the same as those. There's less correlation, which it gives us the diversification we're after. But infrastructure like your freeways, your tolls, your big utilities, that type of stuff around the world has, as you can imagine, these big projects are pretty steady as she goes. You don't tend to get a lot of surprises. So that's a nice form of diversification with income and growth kind of locked in fairly well, but still having some better than bond type performance. So it's not an alternative, but it is a little bit of diversification within those property and growth asset classes.
So to summarise, we use alternatives in most clients' portfolios.
Yep.
It provides diversification. It helps to provide some positive ongoing performance and to smooth the ride out.
That's pretty much it.
And they access it through managed funds, and the risk of them is diversified because they have a whole variety of different strategies and different funds that they're using.
Yeah. So the alternative space is more complicated than other shares and property areas because it's so varied. If clients have questions about it in more detail, happy to go through it. But it is worth, for those reasons that you've outlined, having exposure. The only thing I will mention is that for our high growth and growth clients, we reduce, and in the high growth actually eliminate those alternatives, because similar to what we talked about right at the start, those people aren't necessarily caring too much about a volatile ride, and will basically be looking to just absolutely maximise the end result. But that's why we would reduce or remove their alternative exposure, because they're looking for that extra 1%, and alternatives will kind of provide a defensive part of portfolio that is not really appropriate for those very aggressive investors.
So that's alternatives. There's a lot there. If you've got any questions, please feel free to give us a call. And if you've got any feedback, as usual, please feel free to let us know. Thanks for watching.
Thanks.